Hi everyone, welcome back to Corporate Decoder, the place where we attempt to make sense of a company's latest financial puzzle. Today we're diving into Generation Income Properties' Big 10Q filing, and let's just say navigating this one feels a bit like trying to find a parking spot at the mall on Christmas Eve. So what is Generation Income Properties, or GIPR? Basically, they're in the business of buying and managing income producing properties, mostly retail, office, and industrial spaces across the US. They've been in operation since 2015 and are aiming to be a real estate investment trust, which is a special kind of company that owns income producing real estate. If they meet certain rules, they can avoid paying corporate income taxes on a big chunk of their profits. Now let's jump into the numbers. Looking at their balance sheet as of June 30, 2025, compared to the end of 2024, we see a few shifts. Their net real estate investments actually went up slightly from about $91.3 million to 19 existing ones. But here's what's really interesting. Their cash and cash equivalents dropped quite a bit from over dollar available cash. When we look at how much money they're making and spending, things get a bit more intense. For the 3 months ending June 30, 2025, they reported a net loss of over $3.4 million. For the same period in 2024, the net loss was smaller, around $1.4 million. That's a pretty significant increase in losses for the quarter. The same story plays out for the 6-month period. In 2025, their net loss was over $5.2 million in the first half of 2024. This widening loss trend is definitely something to keep an eye on. Some of this bleeding red ink comes from expenses like depreciation and amortization. These are non-cash expenses that basically account for the fact that their buildings and improvements lose value over time. All companies have these, but for GIPR, these went up from roughly $1.8 million in the first half of 2024. To over $2.5 million in the first half of 2025, this increase in non-cash charges, while not directly taking money out of their pockets today, reflects the aging or expansion of their asset base. But the real kicker is the interest expense. It jumped dramatically from about $2 million in the first half of 2024 to over $3.2 million in the first half of 2025. This huge increase is partly due to costs associated with paying off a loan early in May 2025, which really hit their bottom line. It shows that borrowing money is a significant cost for them, and managing that debt is a big part of their financial picture. When you put all this together, the net loss attributable to the company itself, meaning after they account for non-controlling interests, is substantial. For the first 6 months of 2025, it was a loss of over $7 million. That's far greater than the $5 million loss they reported for the same period in 2024. Essentially, they are losing more money than they are making, and the gap is widening. Looking at the statement of equity, we see that their accumulated deficit continues to grow. This is basically their total losses over time adding up. As of June 30, 2025, this deficit was over $30 million, and their total stockholders' equity is actually negative at over $1.3 million, which is a pretty precarious position to be in. This, combined with redeemable non-controlling interests that are growing, means there are significant claims on their assets that aren't owned by the common shareholders. Balance sheet also highlights under redeemable non-controlling interests a figure of over $31.9 million. This represents claims on the company's assets by investors who have certain rights to have their investments bought back. Combined with the negative stockholders' equity, it paints a picture where the common shareholders' stake is becoming increasingly questionable. A big chunk of their financing involves a company called LC2NN Pref LLC. They made a significant investment with a rather high preferred return rate of 15.5%. What's key here is that this investment has a redemption right, meaning LC2 can demand their money back by August 2025. The company has extended this deadline, but it's a major financial obligation looming over them. The report states that as of June, the redemption value plus accrued interest is nearing $18 million. This is a substantial liability that needs to be managed very carefully, and the increased return rate of 18% on some of it after extension certainly adds pressure. Their debt situation is also a major point. As of June 30, 2025, they had about $54.7 million in mortgage loans. That's down from about $58.3 million at the end of 2024. which is good. They are paying down debt. However, they also had a loan payable to a related party, likely insiders, which increased from $5.5 million to over $7.5 million, $7.5 million, $7.5 million. This reliance on loan payable to a related party, likely insiders, which increased from $5.5 million to over $7.5 million to over $7.5 million to over $7.5 million. This reliance on related party loans can sometimes signal a lack of traditional financing options. Speaking of loans, take the General Services Administration Navy loan of over $8.2 million. The interest rate is about 6.15% and it matures in August 2029. They have to maintain a debt service coverage ratio, or DSCR, of 1.25. This means their property income needs to be 1.25 times what they owe for that loan. It's a standard debt metric ensuring the property can cover its mortgage payments. Now, management likes to talk about things called FFO, AFO, and core FFO. These are ways to look at the company's performance that try to strip out big non-cash items like depreciation and gains or losses from selling properties. They do this to give a clearer picture of the cash flow derived from their actual real estate operations. For GIPR, these measures show their operating performance is also shaky. Even looking at their core adjusted funds from operations, which is supposed to be a cleaner picture, they had a negative number of over $700,000 in the first half of 2025, a sharp drop from a positive 118,000 from operations, which is supposed to be a cleaner picture. They had a negative number of over $700,000 in the first half of 2025. A sharp drop from a positive $61,000 in the first half of 2025, a sharp drop from a positive $161,000 in the same period of 2024. So what's the story here? Generation Income Properties seems to be in a holding pattern, trying to manage significant debt obligations and widening losses. They've made some property sales, which is good for improving liquidity, but it hasn't fully offset the increased interest expenses and ongoing operational losses. The fact that they're flagged for not meeting Nasdaq's minimum stock price and equity requirements is a serious red flag that points to potential funding difficulties and market confidence issues. The large redeemable non-controlling interests and the significant preferred equity obligations, particularly the one with LC2, represent substantial future financial commitments that are a serious risk. Their reliance on related party loans also raises a question about their ability to secure traditional financing. In my opinion, Generation Income Properties is facing significant financial headwinds. While they are trying to improve their situation through property sales and managing debt, the growing losses and the proximity of these large redemption obligations mean they're in a very challenging position. Investors should be extremely cautious as the path to profitability and sustainable operations looks steep. Alright, that's our deep dive into Generation Income Properties' latest report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more Diskeps. Don't forget to check out our Discord community in the description for more discussions and insights. Thanks for watching. See you next time.